Today we'll look at the Magical RSI strategy. RSI is an abbreviation for Relative Strength Index. It's probably the most popular trading indicator, but it also happens to be one of the most useful ones. Here we can see the equity curve, and the strategy has a steady linear growth. We started with 100,000 in 1993 and ended up with 1.4 million today. The chart is log scale, meaning we look at relative changes. The return is 56% per year if we use risk-adjusted returns. The strategy is invested just a short period of time, and we'll get back to risk-adjusted returns later. What's the strategy about? The trading strategy is all about exploiting the mean reversion effect in the stock market. Mean reversion means that if an asset's price deviates significantly from its average, it is likely to eventually move back towards that average. This average in the stock market is the long-term uptrend because of inflation and productivity gains. For example, the US stock market has risen about 10% annually over the last century. However, nothing is linear, and panics do make prices occasionally go down. Sometimes the prices go down a lot, like in 2022 and 2008, for example. And these are the situations we are looking to buy. And we hope to exploit these short-term pullbacks by buying low and selling high by being invested just a few days per trade. So in short, we want to buy weakness and we want to sell strength. Why does the stock market revert to the mean? Well, no one knows the exact reason, but we assume that program trading is the major one. Mean reversion didn't work until 1985, and it was about this time that program trading started to take effect. Other reasons might be short covering, market bias, etc. Let's go to the trading rules, which are really simple. So we're looking at the market, which is S&P 500, and we are backtesting Spider, the ETF that tracks S&P 500. But the strategy also works on other ETFs, for example XLP, which is consumer staple, and XLV, which is healthcare stocks. And we assume it works on other as well. So the entry is when the 3-day RSI is below 20. That's it. It's just one simple criteria to enter. And exit is when the 3-day RSI is above 60 or today's close is higher than yesterday's high. And this is all. So there are one rule to entry and there are two rules for the exit. Let's look at some trade examples. When we run the backtest in Amy Broker, we get the results like this. For example, the green arrow indicates a buy and the red arrow indicates the exit. And here, for example, you can see here, this is the relative strength index, and here the 3-day RSI is below 20 and you buy. The RSI goes up because the price goes up and you sell. And here you can see the second trade, third trade and fourth trade, all with a decent profits. So during this period we had 4 trades in a row with a profit. Let's look at the backtest results and statistics. We had 351 trades since 1993, and the average gain per trade is 0.8%. The annual return is 9.2% versus buy and hold, which is 9.7%. And 78% of the trades are winners. You are invested on average 5 days per trade. That means you are invested 16% of the time. That means that risk-adjusted return is 56%. How to get to this number? You simply take 9.2%, which is the annual return of the strategy, and you divide it by 0.16, which is the time spent in the market. Max drawdown is 23%. All in all, we would say this is a pretty good result, because you spend such a small amount of time in the market and you still get a result which is more or less on par with buy and hold. If you want more trading strategies, we have hundreds of them on our webpage quantifiedstrategies.com.